The second goal for a society to consider in terms of their priorities is economic growth. And so when we look at economic growth, we're looking at a change in the amount of goods and services that a country or an economy produces. And really, economic growth and standard of living go hand in hand. Because if your country is producing more goods and services, they should be paying their workers more, in which case your households are now buying more goods and services. So economic growth and standard of living often move together. Now, when we look at economic growth, we measure economic growth in terms of real GDP per capita. And so it's important to break that down and look at why do we look at it in real terms and why do we look at it per person. So GDP, let's define that first, or gross domestic product, is the total final value of all goods and services produced in an economy, typically in a year. Now, when we're looking at the value of what we make, if we do it in nominal terms as opposed to real terms, well, nominal terms are the market value. So that would be what you would pay right now for those goods and services. But the problem is we want to know whether or not our economy is growing over time. Well, over time, you could pay more for goods and services simply because of inflation. It doesn't mean, though, that you are getting access to more or better goods and services. You could simply just pay more for the same stuff. And so by looking at real GDP, we take out inflation, and then we can compare the amount of goods and services we're making from year to year to see if we're making more or better things. Okay, so we're looking at real GDP, and we're looking at it per person. Why? Because we want to know if individuals are getting access to more goods and services. And so we take the total value of what we produce and we divide it by the population. We don't want our population to grow faster than the goods we produce. If the population grows faster than the stuff we make, are we better off? Well, no, because we each get less. And so we want to look at real GDP per capita to see if the average individual is going to have access to more goods and services. Well, how do we get economic growth? We could increase the labor force, right? If we have more workers making more goods and services, then the economy should grow. Or we can take those same workers and we can get more from each of them. Okay, so to get economic growth, we either need more workers or we need more from each worker. Now we have to be careful about increasing the labor force because again, if the population grows faster than the amount we're making, we're not really better off. Now when we look at real GDP per capita to tell us whether our economy is growing, we have to consider that not everything is included in GDP. And we'll look at this in more detail later this semester, but when we look at GDP, the government determines the total value of everything we're producing in the country. So in order for it to be part of GDP, we have to tell the government that something is being made and it's being sold. So anything that's not being reported to the government then is not included in GDP. So not included would be any illegal or black market goods. Right? Because you're not going to say, hey, Revenue Canada, I'm a drug dealer. Here's how much sales I did this year. And so since you're not reporting it, well, it wouldn't make sense to, it's not included in gross domestic product. We also don't include the sale of used goods. So if you have an old Honda Civic that you're selling on Kijiji, That's not included in gross domestic product. It's only included the year that that car was initially built and sold new. If you're doing housework, okay, then that has value to your family. Maybe you're cooking or cleaning for your family. It has value to your family, but because it's not being paid and then reported on tax returns, it's not included in gross domestic product. The other thing that we don't consider when we look at economic growth measured by real GDP per capita is the issue that economic growth can lead to higher rates of pollution, depletion of resources, more traffic congestion, more stress, you're working longer hours. So it doesn't take those things into consideration. We're looking simply at how much goods and services are being produced and are we making more. And the idea here is that if we're making more per person, then as a society, we are better off. Well, how have we been doing in terms of economic growth? So let's look at some charts here. And you can see from 1926 to 2007, our real GDP increased 19 times, and it's continued to increase since then. These little dips that you see here, for example, those are recessions. So we can see a downturn. We're decreasing our real GDP. And so the economy is contracting or shrinking. So we're experiencing a recession. To see a bit better those recessions, let's take out that long-term growth trend, and here you can start to see more of that recession period. So here what we're seeing is that 2008-2009 recession, and you can see that negative economic growth during that period. Well, as we look at other countries, what countries are seeing the most growth and the least growth? For the last decade or so, the country that has seen the most economic growth has been China. It's been 6 to 10% per year. Since then, it started to slow down. There are concerns that some of that growth in China has been a bit artificial. That is government spending on huge infrastructure, big buildings, building ghost cities, they call them, since no one lives in them. That's creating jobs and creating goods and services, but not necessarily a true indicator of how the economy is doing because it's being propped up by government spending. In that same time period, we see growth in Canada about 1 to 2%. So if you look and see which economies are seeing the most contraction, negative economic growth, we see Venezuela there, and we have some other videos that you can check out in terms of what's happening in Venezuela. So we said that we can get economic growth by increasing our labor force, so getting more people, or by getting our workers to be more productive. And so we can see here what's happening with the productivity of our workers, so how much the typical worker makes. In Canada, the typical worker makes $83,891. Notice that's twice as much as the average worker gets paid. So we make more goods than we are getting paid for. How does that compare to the U.S.? Well, the U.S., the average worker makes about $112,000 worth of goods. So the U.S., there's more productivity per worker. And really this comes down to investments in capital goods. Remember what capital goods are? Capital goods are goods that are produced, so someone made it and it's used to make something else. So we're talking about machines, tools. The US uses more automation than we do in Canada, and so that means the typical worker is able to make more goods and services because they're overseeing more machines doing it. China, the typical worker makes about $25,000 worth of goods, and this is about double what it was just over 3 years ago. In China, there is a lot more labor-intensive work. So, for example, if we look at Dow Chemical as a company, well, they fill hoppers full of little plastic pellets. In Canada, that would be automated, and they would be filling these hoppers about one every 2 hours or so. In China, all of it's done by hand into bags instead of big hoppers, and then carried manually to the locations. So they're using labor rather than mechanization. On the right here, you can see productivity in Canada over time. And what's interesting to note is this big uptick in 2009 in productivity. So what happens after a recession is we see a big boost in productivity. And the reason is because when the economy is starting to do just a little bit better, businesses are a bit reluctant to hire a bunch more workers. They want to make sure the economy really is doing better. So what they do is they'll pay overtime, they'll expect more from their existing workers before they hire. And so we see a productivity boost per worker as workers are taking on multiple workloads before businesses go on to hire more workers. So you can see then that productivity starts to fall again when businesses become more confident and then increase their number of their staff. Mostly, though, the productivity levels in Canada have been very flat. And in fact, the International Monetary Fund, the Bank of Canada, the Canadian government, they're constantly warning that this lack of increase in productivity, it's going to have an effect on the Canadian economy. And it's going to be difficult for us in Canada to see economic growth with productivity continuing to be flat for year after year. We want to do a comparison of productivity across countries. Take a look here, and this table actually came from Scotland, which is why it's the bold one there, so from the Scottish government. But you can see Canada here in terms of our productivity, and we can see the US here. And so remember, US is a bit more productive than Canada because of the greater use of capital goods, as well as the creation of more finished products. So countries that have higher productivity tend to be countries that create finished goods. Whereas countries with lower productivity, they're countries that produce more raw materials. And it really comes down to the value added, the difference between the cost to make it and what you can sell it for. When we talk about creating raw materials, so if we're talking about mining or lumber, there's not as much of a difference between the cost to make it and the price that you're selling for. It's going into something else. But finished goods, like iPhones and laptops, there's a lot more value added in terms of the difference between the cost to make it and what you can sell it for. So the productivity per worker, in terms of the value of what they make, tends to be higher. And so countries that have more finished products tend to have higher productivity than those who are making primarily raw materials.